is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Cracks in Frankfurt. Bloomberg learns not all ECB policymakers supported a 75 basis point hike, while the euro pairs some of yesterday's plunge as the yen whipsaws. Not so Merry Christmas. Amazon and Apple warned of a slowdown this holiday season. Elon Musk is said to take over as Twitter chief executive and wants to reverse lifetime bans. Plus, VW stalls. The auto giant actually tumbles as it cuts its full-year forecast for deliveries amid supply chain troubles and misses profit expectations. Now, we're getting some breaking news. We had GDP out of the euro area. German GDP is just coming out as we speak. Euro dollar, you can see 99.51. Now, this has mostly to do, and we did see a bit of weakness, or more weakness that we've seen in the past in dollar, but also that dovish stance from the ECB. That's certainly how markets are interpreting it. German third quarter GDP growing at an adjusted rate of 1.2% year on year. That's not having a huge impact on euro, but if you look at what we've also heard from Spain and some of the other countries, of course, if we see a softening of some of these GDP figures, and actually that third quarter, quarter on quarter coming in at 0.3%, so pretty much in line with expectations. But if we do see a bit of softening in that data, then really the pivot could be happening. There is, though, a bit of a bias in certain parts of the markets. Traders have been telling us that they've been waiting for this Fed pivot for quite some time, and maybe they've also been pricing in and hoping for an ECB pivot as well. This is the picture for the DAX. If you look at the DAX, down 1%. Technology stocks, again, under pressure because of Amazon. Out of all the big technology stocks that we heard this week, and Matt Bloxham was right on the money of this, it was maybe only Apple that didn't disappoint as much as the others. Banks, Credit Suisse, actually, after falling some 20% yesterday, is now gaining a touch. NatWest, there's something in the earnings that also traders are worrying about, and that's under pressure. All right, let's look at the map to see whether there is a huge difference, but overall I don't think there is, because natural resources and some of the technology stocks are down between 2 and 3%. You can see the CAC 40 down 0.7%, and then the DAX, for example, down 1% as well. Let's also look at what we're seeing for U.S. tech. Now, pre-market, actually post-market yesterday, Amazon was significantly down, currently down 14%, Twitter unchanged. But this is because he bought the Twitter shares. So we'll have a look at what this means. And then Apple gaining 0.2%. Now, the ECB hiked by the expected 75 basis points. But Bloomberg has also been told that officials were not actually unanimous about the size of the increase. Despite that, ECB President Christine Lagarde has signaled more hikes are on the way.
We took today's decision and expect to raise interest rates further to ensure the timely return of inflation to our 2% medium-term inflation target, following our meeting-by-meeting approach.
For more on this, let's go straight to our Maria Tadeo in Brussels. Maria, they hiked by 75 basis points. The press conference, although, was very nuanced.
It was very nuanced, and Francine, it was a big hike, 75 basis points, of course, very well guided, calibrated, but it was a big hike. Yet, nonetheless, the conversation this morning feels very different too. You could argue, well, the day after to a 75 basis points hike should be. Today, of course, there's a lot of questions around the nuance in that press conference. The fact that Christine Lagarde did not want to put a number in terms of the potential hikes to come. She continues to say we're on a journey to a destination. That means completing our goal as a central bank. You have to bring back inflation to target. We're not there yet. But in terms of the numbers, she did not put one in there. She also mentioned that there had been, well, not a lot of details around QT in that meeting, that it didn't really feature, but the principles could come up in December. And when it comes to the signaling in December, and that is the key here for many, and in fact, again, it goes back to the story that we're reporting overnight on the Bloomberg, is that within the Governing Council, there was also a debate as to what kind of signal do we want to send come December. I think that also is feeding into some of the calls this morning being revised. We have Deutsche Bank, just to give you an example, that's revising that call from 75 basis points in December to now 50. So there is a lot of nuance that is now potentially will lead into weeks of debate before we get to December.
So, Maria, we're getting quite a lot of data points. That German GDP, how will that factor in?
Well, the German GDP, which was actually, stronger than predicted. But remember, when you talk to German officials and the German industry, they still say we predict a recession by the end of the year. This is an economy that is facing so many different challenges. When you look at the inflation picture too, where you have the Spanish, the French inflation is hot. The Spanish is cooling nonetheless. They still are hovering around 7%, which is way above the European Central Bank target. But overall, if you put all of this data combined, it also highlights just how difficult it is for the central bank to get the right tone and the right policy when you're dealing with so many different economies that right now, Francine, have such different dynamics.
Absolutely, Maria. Thank you so much. Maria Tadeo there with the very latest, of course, on the ECB. Now, we're also getting some breaking news out of the BOJ, boosting bond purchases, a plan for mid-quarter for the first time. This is coming out of the press conference that Governor Kuroda is giving as we speak today. Despite a push from the markets, they didn't actually change their longer-term outlook. And you can see yen 147.27. Now, we're joined by JP Morgan global market strategist Hugh Gimber. Hugh, great to have you on the program. Earnings. I mean, are we fed up of earnings so far? What did they tell us?
So the earnings season has not got off to a great start very clearly, but I think this has been long anticipated. So the themes that are coming out of Q3 earnings season in terms of rising costs, in terms of a weakening consumer, in terms of dollar headwinds for the US companies as well, these are all themes that have been discussed for some time. But I suspect that now is probably the catalyst to see the downward revisions that have been broadly anticipated starting feeding through, because the guidance has been pretty weak and stock markets have jumped on this. So if you've missed earnings in this season, you're down even further than you would normally be. And for the companies that have been beating, there's really been little reward to be had. But
so why are actually, if you look at the share prices, and I know you don't talk individual stocks, but if you look at Amazon, if you look at some of the others, I mean, they were down like 1/5 of their market value. Does it really have more to do with valuation than the actually underlying stress that they could see in the economy?
I mean, there are a couple of takeaways. So first of all, multiples clearly are still not cheap enough to justify being able to absorb some of these earnings hits, right? So people have been talking about
so that's a good correction.
Well, it will be eventually, right? If you're adding in now over the next 12, 24 months, then yes. But I think the key point here is that growth stocks in particular have seen a major correction this year, but are still trading close to levels that we were at prior to the pandemic, where everyone was already saying, "Ooh, growth is looking pretty expensive here." So yes, there's been a big correction in multiples, but not enough, particularly in the growthier sectors. I think going forward, you have to be thinking, where are margins going to be holding up? Where are earnings still going to be downgraded, but perhaps less? And then where are the cheaper sectors that do have some more wiggle room to absorb those?
So given those three very good questions, where are you expecting them to go? Do equities from here or certain sectors maybe go through another 10% correction?
Look, I think it's hard to say that we're at the bottom here. I think the outlook is still a challenging one. The important point, however, is to say that markets already have moved in anticipation of some level of earnings correction, right? So this is a very typical pattern. We've seen this in most downturns, that prices move first, and then it will take some time for analysts to catch up in terms of earnings expectations. It comes down to your view on how deep a downturn we're looking at in 2023. And that really hangs on how quickly inflation sorts itself out, because a moderating inflation path that allows central banks to take a breath in Q1, I think gives you that mild recession. We think quite a lot of that now is already in the price.
Hugh, thanks so much. Hugh Gimber, JP Morgan global market strategist, stays with us. Also coming up, we speak to the Swiss Re Chief Financial Officer, John Dacey. So we'll ask him about insurance, reinsurance, and of course bonds. That conversation is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Swiss Re reported a third quarter loss of $442 million, driven by claims tied to the damage from Hurricane Ian. The Zurich-based reinsurers Keenet saw $2.5 billion in claims related to large catastrophes, including the storm which hit Florida last month. Well, joining us to unpack all of these numbers, Swiss Re Chief Financial Officer is John Dacey. John, great to have you on the program. How worried are you that some of these events events will continue happening because of climate change, and it will be extremely difficult for the reinsurance companies to absorb it?
Well, in the first case, it's inevitable that these types of events will continue. We expect them to continue, and we price for an expected loss related to that. What I can say is climate change has unambiguously adapted our views on the frequency and the severity of what we call secondary perils. These are the floods, the wildfires, the hailstorms that you see literally around the world, where the losses are of a material difference than what they might have been 10 years ago because of global warming. That said, we think we've reduced our exposure to some of these perils while maintaining our position to be a strong provider of risk cover for true catastrophe losses. What we saw in Florida, Hurricane Ian, with sustained winds of 150 kilometers an hour, is the kind of damage which our models think is possible. We don't welcome it. We're enormous sympathy for the people that have suffered the losses here, but we think we can price this and continue to give adequate cover to the primary companies that take the first loss.
Yeah, and Hurricane Ian hitting Florida was actually one of the strongest hurricanes to ever make landfall in the U.S. I think we're looking at pictures of, the trail of ruin that it left in southern Florida, damaging bridges, inundating roads, and shattering homes. When these events happen, who do you call first? What is the reaction function of someone like Swiss Re?
Well, we immediately sort of check our own models to be sure that we've got a handle on what kind of loss this could be for us. And then the calls are into the primary companies. Ultimately, they're going to be responsible for delivering the funds that we give to them to the people that have actually suffered the losses. Our reservations for the Hurricane Ian were $1.3 billion. We think that's a prudent total loss that we will have. We will look at the actual reported losses that come through our clients over the coming weeks and quarters to be sure that that's appropriate. But every indication we've got to date is that that should be more than enough to cover what our exposures have been for this loss.
Will premiums and fees go up?
So the reinsurance market in particular is frankly in a moment of disequilibrium. It's clear that there are some people that have seen the last 5 years and have decided they're going to stop providing capital for these risks. Some of them are reinsurers, some of them are the capital market instruments referred to as ILS, where both catastrophe bonds and other investors have decided that they're simply tired of the scope and amounts of losses that they've suffered as a result of a series of events around the world. Swiss Re remains committed to providing capacity, but it will provide that capacity at a price level and in structures which we think are fair to all of the people, not just our primary clients, but also our shareholders. That said, we expect in the January 1 renewals prices to go up substantially. And the structures of the risks to be adapted to the kinds of layers where we think it's appropriate for us to be on risk.
All right. Thank you so much, John Dacey, there for all of the insight, of course, on Swiss Re, one of the most interesting companies coming out today, Swiss Re Chief Financial Officer. Coming up, as the first week of European earnings season begins to wrap up, we delve further into the details of the results and, of course, look forward to the first quarter. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News with Leanne Gerrits. Hi, Leanne.
Hi, Francine, and happy Friday. Japan has announced a $490 billion economic stimulus package, including an extra $200 billion in government spending. It is designed to ease the impact of rising prices on consumers and companies and also support growth. Now, it came ahead of a decision by the Japanese central bank to continue continue with negative rates and its a policy of capping 10-year bond yields. Now, the European Union has reached a deal that will effectively ban new combustion engine cars from 2035. The plan will require automakers to cut emissions by 55% by the end of this decade and comes ahead of climate talks happening in Egypt. The agreement between member states and the EU Parliament marks an unexpectedly rapid advance for one of the most controversial proposals by Brussels. The CEO of South Africa's largest bank has weighed in on the South African government's plan to take on billions of dollars of debt from the state-powered utility Eskom. This after the country's finance ministry this week set out ambitious targets to stabilize the public finances.
I guess the challenges are not much clarity on what's going to happen with the financing of Eskom. The authority spoke of to a third to two-thirds of the Eskom debt being taken over by government. Is it going to be 100 billion? Is it going to be 300 billion? Not entirely clear. It's also not clear over what period. And I think that creates uncertainty in the forecast.
And here in the UK, the new Prime Minister, Rishi Sunak, has demoted 2 climate change ministers and decided not to attend the annual United Nations summit next month. Sunak's predecessor, Liz Truss, had planned to go to COP27, the meeting's happening in Egypt. His office says he won't attend due to other pressing domestic commitments. Bloomberg sources say Elon Musk has completed his $44 billion acquisition of Twitter. The world's richest person takes charge of the social network after 6 months of public and legal wrangling. Musk has wasted no time on sweeping leadership changes with departures of CEO Parag Agrawal, CFO Ned Siegel, as well as the policy head and general counsel. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much, and happy Friday to you. Now, it's been a busy first week of earnings season with mixed results across a number of sectors. Let's bring back JP Morgan global market strategist Hugh Gimber. Hugh, we're talking a bit before about some of the earnings, especially in tech. I don't know whether the banks give us a bit more of an indication. I'd like, okay, you wake up every morning and you think, what do I not want to miss? And is that what U.S. and European consumers do?
I think that's right. At the moment, the message from the banks has actually been relatively upbeat so far, particularly in the US. I think there's this mix here where the banks have come into earnings season with very strong capital positions. Very, very different situation compared to in the run-up to previous downturns. But still, that consumer weakness is going to feed through. And particularly when you look at the UK and the Eurozone, I think now that's really the message which is coming through loud and clear. You've got higher mortgage rates weighing on disposable income, and you're starting to see some signs of labour market softening as well.
But you're not really seeing it in the bank earnings, so I don't know whether it's a time lag, so there's a problem with the timeline, or whether they're not seeing it because they were more risk averse, and so their model is kicking in and it works.
I think it's perhaps a bit of both. You've also got the benefit that the banks are getting from higher interest rates in the UK and the Eurozone, right? Finally, you're looking at much more positive yields for the banks to be working with. So it's been a bit of a mixed bag, but certainly I don't think that the sort of negativity around earnings season is only a bank one. There are other sectors getting hit much harder.
Okay, if you look at this global change, when you look at bonds, I mean, is there a wanting in the markets for the Fed pivot or for dovish ECB that maybe will be short-lived?
So the central banks are looking for an off-ramp here. That, for me, is the message that we've had over the past few weeks.
Is it markets thinking that they're looking, or is it really you think central banks are looking for it?
So you look at what the ECB said yesterday. They are saying, we've made substantial progress. We feel we're much further along. They need now the data to cooperate. That's the missing piece of the puzzle. But I do think what's changed in their language is that the growth outlook is back on the table. So for the first 9-10 months of this year, the only message that we've heard as investors from the central banks is we don't care about growth, it's all about inflation. Now what's been different over the past week or so is that that inflation mandate is still there, but the growth considerations are starting to work their way back in, which I think justifies why now the markets are so desperate to see signs of a pause. Provided that you continue now to see inflation improving over the next couple of months, I think you will be looking at central banks on hold in Q1 next year.
So you don't think we could see a massive downturn? I don't know when I got so pessimistic, actually, but it is quite warm. Energy prices are stable. Could it not turn on its head quite quickly?
So, I mean, I think recession next year is baked in now. It's really a question of how bad does it get. You're absolutely right that the winter, or the autumn so far, I should say, has gone about as well as you possibly could have hoped in Europe, right? The longer-term problems are still there, but at least in the short run, you've not had Europe having to run down energy supplies in advance of the winter. In the UK, we've had progress as well in terms of the government changes. So I think you look at next year and you say, we know there are problems, we know there are pressures with inflation, but provided that those headline numbers start to come down, it allows the central banks to pause, it softens the depth of that downturn.
Hugh, thank you so much. Very quickly, does dollar weaken from here?
Hard, very hard. I think it has to come from somewhere outside of the US. I struggle to see a macro picture in the US that weakens the dollar.
All right, Hugh, thanh you so much. Hugh Gimberther, JP Morgan global market strategist. Now, coming up, Amazon projects its slowest ever growth for the holiday season. Apple also warns of a slowdown. We'll have the latest on Elon Musk's Twitter takeover as well. This is Bloomberg. Germany's economy unexpectedly grew in the third quarter, boosting hopes that the Eurozone can stave off a recession. Not so Merry Christmas, Amazon and Apple warn of a slowdown this holiday season. Elon Musk is set to take over as Twitter chief executive and wants to reverse lifetime bans. Plus, VW stalls, the auto giant tumbles as it cuts its full-year forecast for deliveries amid supply chain troubles and misses profit expectations. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. Happy Friday. I'm Francine Lacqua here in London. Now let's turn to big tech earnings. Amazon has projected its slowest ever growth for the holiday season, while Apple has also warned of a slowdown. Elon Musk is also said to be planning to take the chief executive role at Twitter after completing the contentious $44 billion deal. Well, joining us now is Matt Bloxham from Bloomberg Intelligence to make sense of all of this. So first, Matt, what's the latest on Twitter? So we don't know what he wants for this platform, do we?
No, I mean, obviously he said he's doing it for the good of humanity and he wants to, create this kind of town square, if you like, that's kind of full of free speech. So, you mentioned the reversal of lifetime bans. Whether we see people like Donald Trump come back on the platform, we'll have to see. And what the kind of framework about how that platform operates is still unclear.
Yes.
We heard yesterday that he wrote a very long letter to advertisers trying to reassure them that this is going to be a responsible environment and they should continue to invest marketing dollars there. So, but, how it's going to turn out, we'll have to see.
Yeah, and I think he tweeted, I mean, I love that tweet, the bird is freed. I mean, he's really a marketing genius. But he was talking about citizen journalism. And again, where do you draw the line between that and fake news? And what are there advertisers that are making noise already about, pulling out? Yeah,
there's definitely been there was some commentary yesterday that some big brands, are definitely kind of pulling back whilst they wait to see what happens. It's a big risk. Brands are very worried about, kind of associating their products with the wrong content. And I guess unless you're very clear about the content moderation or how brand advertising is going to be placed against content on Twitter, then I think there's going to be some nervousness there for a while.
But underlying, do we understand what he wants Twitter to become? Could it be like a platform like Alipay or Alibaba, or is it just too soon?
Too soon. I think certainly, the sense is it's going in that direction. It's obviously a almost completely ad-funded model today. He's definitely talked earlier about wanting to introduce some kind of subscription element to it, extending the kind of capabilities of the platform. He's clearly going to need to generate lots of money from it to fund the debt he's taken on to buy the company and keep his co-investors happy. So I think there's going to be some substantial changes to the business model.
I could talk to you about Elon Musk and Twitter for an hour, but I do need to talk about Amazon because they were slammed post-trade.
Yeah, tough, but very similar print, I thought, to Google, where, essentially the numbers themselves for the quarter weren't that bad, but the outlook was pretty horrible. 2 to 8% growth in the final quarter. The market was looking for 13%, and not much of a profit there either.
But Matt, is this because we're expecting too much? The valuations are expecting too much, or is it because we really worry about a downturn? Is this like a barometer of how ugly it gets in terms of consumer spending?
I think it's a mixture. I think we've just kind of seen recently this kind of shoot first, ask questions later kind of attitude of investors. I mean, the strange thing is we've been talking all year about a downturn, and it's just coming later and later than what people expected it to, and it now seems that it's kind of finally turning into something real. I think that the thing that investors are struggling a little bit with, particularly with Meta, to some degree with Google and with Amazon, is that they're still spending heavily, so there's not really much profit coming through, even though these are enormous companies.
Apple wasn't too bad, though.
Apple was okay, yeah. I mean, they're still talking about a slowdown in Q4, but iPhone sales were pretty good, had a really blowout quarter on Mac. Services are growing, so relative to their peers, actually a good print.
I want to know what's on Matt Bloxham's Christmas list. Matt, thank you so much. Matt Bloxham from Bloomberg Intelligence. Shares in Volkswagen are also down today after it missed third quarter profit expectations. The car maker struggled with cost pressures from supply chain problems and booked one-off charges for its listing of Porsche. Now, a short time ago, I spoke with the VW chief executive, Oliver Blume, about that listing and his future strategy for the group.
The Porsche IPO was a big success for the whole group and has shown unleashing the full potential of our brands. And the Porsche IPO is a role model for the whole group. And we are thinking in different approaches to lift up the value of the whole group. I'm very confident how to do it. And therefore, we launched an activity to work in so-called virtual equity stories in all brands, to focus on the right things, to sharpen our strategy in the brands, and then in the future we will see where we have opportunities being more attractive in the capital market. For me, the capital market is one of my main importances when I started the job, and I'm looking very much forward to develop the brand towards this direction.
The EU, this is big news this week, the EU is banning combustion cars new sales from 2035. Will the region and the customers be ready?
Yeah, important is that on the one hand side, the product will be there. The Volkswagen Group is prepared to go for it. And important is also that the infrastructure, when it comes to charging, will be prepared up to 2035. For us as a global group, it's important to be flexible during the ramp-up curve. And as I told before, the different regions of the world are moving at a different speed. We will be prepared, and we will be prepared in Europe. And we will support, beside of our product strategy, also the ramp-up of the charging infrastructure.
You're also heading to China in early November as part of a high-profile business delegation with the Chancellor Scholz. When you look at the market share of VW in China, it seems to be slipping. What's your goal when you get there?
Yeah, everything starts with the customer perspective, and therefore we have to develop our brands to be attractive for Chinese customers. China play a very big role for Volkswagen Group. We have a very successful history during the past decades, and there we want to continue, and with our partners in China, and bringing stunning projects and products to the market, to excite our customers in China.
Well, that was the VW chief executive, Oliver Blume. Coming up, shares in UK lender NatWest take a hammering after missing third quarter estimates. More on that next, and also a wrap of the week that's been in bank earnings season. This is Bloomberg.
What we're seeing at the level is customers are managing their balance sheets very well. We're not seeing a deterioration in performance. Deposits remain very high on customers' accounts. They're adjusting their spending in light of the cost of living challenges. And at a business level, businesses continue to perform well. There's obviously a lot of stress and people are very concerned about the outlook. But in terms of real performance in our book, we're not seeing a deterioration. Defaults remain at very low levels. The book remains very resilient. So it's really us just taking a cautious view given the economic outlook has clearly worsened since I talked about our half-year results.
So I just do want to be clear here, Alison, just trying to, square this. So you are lifting, again, your impairment charges, but defaults are steady. So do you then expect that to remain the same? As you say, this is just precautionary, but you don't expect that will actually enter a big default cycle?
Well, what we're saying is the economic outlook has clearly worsened. So we're taking more provisions. What we're saying is our forecast for the end of the year is impairments around the 10 basis points, and our guidance for next year remains the same. What we're saying is there's a degree of caution. What we're not seeing in our customer performance is a deterioration. We're not seeing delinquencies. We're not seeing customers go into default. But the outlook is more challenging. So we're weighting more to the downside. But overall, customer performance remains very resilient.
Well, that was the NatWest Chief Executive Officer Alison Rose speaking to Bloomberg a short time ago about the bank's third quarter earnings. So let's get a closer look at what we heard about the banks with our Tom Metcalf, who oversees our UK banking coverage. Tom, good morning. When you look at NatWest, it was pretty slammed, actually, in terms of the share price. What did the market say? The Chief Executive was trying to paint a picture of resilience, which the market is just not buying.
Yeah, exactly. NatWest shares down 8%. That is a big fall.
That's a lot.
And it's in some ways quite surprising because what they're saying is not that. It's not a surprise, right? That, hey, we're expecting inflation might boost our costs. We're seeing some signs of at least, economic worry. They're very clear that their own book has not sort of seen big signs of default. But yes, I think the market's really taken fright at that idea that costs might rise. And also, it's perhaps just becoming abundantly clear that next year is not looking like fun for the UK economy. And that obviously will really hit bellwethers like NatWest, Lloyds pretty hard.
In terms of mortgages, or in terms of, do we actually worry about loans from companies, or we could have zombie companies?
Well, both. So NatWest, the biggest corporate lender in the UK, so you'd expect that business to be pretty hard hit. We're hearing that companies are largely being very cautious. They're also it's such a difficult environment to sort of make those long-term investment decisions. So corporate loans you'd expect to fall. And of course, on mortgages, like we all know, everyone's getting very worried about these rate rises. Even if you're on a fixed mortgage, you're going to roll off that maybe next year. How do you respond to that? All discretionary income spend's come down. So there's a lot of sort of headwinds. And that's probably why, right across the board of lenders, it's a tough situation. I
mean, there is so much uncertainty also on, a possible housing crash, on, as you say, what happens to inflation, mortgages. The other big unknown is what the Chancellor and actually the Prime Minister, the ex-Chancellor, does with taxes. Are we going to see a windfall tax on a lot of these banks? On all these UK banks, actually?
Yeah. Well, behind the scenes, that is basically what the City of London is most focused on. What they want to see is that everyone's calling for stability, fiscal stability, and what that really means is don't raise taxes on us. So it'll be really interesting to see. There's kind of a range out there. Under Sunak as Chancellor, it was going to fall to, I think, 28%. And there's now a bit of a worry among bankers that maybe it's going to rise a little bit more as the Treasury looks to sort of fill that big fiscal hole.
Tom, so we had a very, very busy week. I mean, you had an incredible busy week on earnings with banks overall. What's the crop being looking like? So we had European banks. We also had some of the Swiss banks. I mean, I know we spent a lot of time talking about Credit Suisse yesterday. Is it better being in the UK than elsewhere in Europe?
I think in terms of sentiment, it seems that the banks on the continent are a little bit more positive. Their guidance has been a lot more sort of benign than what we've seen out of the UK lenders. Certainly, their share prices have done better this week. But again, it may be, the UK as a canary in the mine. It's kind of perhaps signalling, I think it's fair to say the global economy will be pretty negative next year, and perhaps just because the UK is much more open to those things, it's sort of starting to see that before. So yeah, tough times for all banks, I think.
Yeah, but the banks, I mean, this was their moment to shine, right? Interest rates going up, they could make money on trading, and actually the US banks did so well. When do they catch a break? I mean, when do they catch a break? We speak to a lot of bank CEOs, and they always say, look, valuations that don't make sense. if you look at what we do compared to some other sectors.
Yeah, no, exactly. And I mean, if you do look at the net interest margins, they're all up. Yeah. But yeah, perhaps they're not getting due credit for that. I think investors are probably going, great, we knew about that, but how are you doing on costs? How are you going to cope when defaults start to come through? And I don't think there was that sort of optimism from the executives that perhaps they were looking for.
Tom, thank you so much. Tom Metcalf there, who oversees all of our UK banking coverage. He was actually on the podcast talking about UK banks this week, so check that out. And also coming up on Monday, after a year on the job, the chief executive of Barclays gives Bloomberg his first TV interview. That starts on Monday morning, and then an hour after that, we'll put it on the Bloomberg terminal. Coming up, we speak to the Air France-KLM chief executive. He is Benjamin Smith. We'll be joined by our very own Guy Johnson. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's go straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Japan has announced a $490 billion economic stimulus package, including an extra $200 billion in government spending. It is designed to ease the impact of rising prices on consumers and companies and also support growth. It came ahead of a decision by the Japanese central bank to continue with negative rates and its policy of capping 10-year bond yields. Now, the European Union has reached a deal that will effectively ban new combustion engine cars from 2035. The plan will require automakers to cut emissions by 55% by then the end of the decade and comes ahead of climate talks happening in Egypt. The agreement between member states and the EU Parliament marks an unexpectedly rapid advance for one of the most controversial proposals by Brussels. Here in the UK, the new Prime Minister Rishi Sunak has demoted 2 climate change ministers and decided not to attend the annual United Nations summit next week. Sunak's predecessor, Liz Truss, had planned to go to COP27. The meeting's happening in Egypt. His office says he won't attend due to other pressing domestic commitments. Bloomberg sources say Elon Musk has completed his $44 billion acquisition of Twitter. The world's richest person takes charge of the social network after 6 months of public and legal wrangling. Musk has wasted no time on sweeping leadership changes with the departures, including the CEO Parag Agrawal, CFO Ned Siegel, as well as a policy head and general counsel. Now, the U.S. economy's recent rebound is looking like a high watermark for expansion. Third quarter GDP rose 2.6% at an annualized rate, but investment in residential housing plunged at an annual rate of 26%. And the engine of the economy, consumer spending, rose a relatively weak 1.2%, and that was from the previous quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, Air France-KLM says it's optimistic it can raise capacity in the winter months as travel demand remains strong. The earnings add to evidence that passengers are still rushing to book trips despite the cost of living squeeze. Let's get straight to our Guy Johnson. Guy, it's not only, I have to say, this is a disclaimer, you're not only like a resident expert on all things airlines, you're also a great sounding board on where we need to book and what airport we need to fly. So Guy, what's it like? Are bookings holding strong as we get into the Christmas months?
So that's the surprise. And what we've heard from Air France-KLM this morning is confirmation of what we've heard from Lufthansa and IAG. We knew that demand was strong through the summer, Francine, and now we're getting it continuing into winter. And that is a surprise to some, maybe not all. The issue, though, for the airline sector continues to be what happens with costs. We've just seen French inflation come through at 7.1% this morning. That's going to be an issue going through the winter. Ben Smith is the Air France-KLM Group CEO. Benjamin, good morning. Thanks for taking the time to be with us. Look, the numbers look good. The winter is looking surprisingly strong. Are you surprised how strong demand is going into the winter? We've got, obviously, a cost of living squeeze that is biting. Inflation is a factor. And, well, it's winter, Ben. What's going on, and are you surprised?
No, I wouldn't say we're surprised. we anticipated a strong return. We've had our fleet ready. We've had the necessary crew in place, pilots, cabin crew, and ground. I would say in a much better position than our main competitors. As you can see, this summer we were able to operate at Air France exactly what we had planned. So well over 85% of our capacity, and we expect to be at 90% later on this year. So we are very bullish on the trends continuing. We saw strong demand out of the U.S., and we expect as markets in Asia open up. The one dark cloud for us has been the operating performance that we've had to endure at Schiphol Airport.
Yeah, I was speaking to the KLM CEO in Amsterdam about that very issue the other day. It looks like we're going to see maybe long-term capacity constraints. You bring up the issue of the US, though, Ben. So let's talk about the US dollar. How much of this demand is supported by the strong US dollar, allowing Americans to fly in and within Europe?
I would say two big trends that we're seeing. One, the strength of the U.S. dollar, as you just mentioned, is a big part of that improvement, or not improvement, of the performance. But number two is what you've heard from other airlines, is this new group, this new segment we're calling luxury leisure. These are people that have the means to fly in the premium cabins. Air France has historically had 50% of its customer base in the premium cabins filled by customers who fly for leisure purposes, and we're seeing that increase. So the impact of lower business demand on our premium cabins is less so than many of our competitors. So this is a trend we're seeing in other markets. We expect as some of the Asian markets open up, we should see the same.
We've seen French inflation data this morning, 7.1% for the month of October. That's the highest in 25 years. What do costs look like going into next year, Ben?
Well, I think we've done a relatively good job compared to our competitors in maintaining costs. We see the increases in the U.S. market. We know our costs now relative to our big U.S. competitors are in very good shape. We had a long way to go, especially at Air France. We started from a very high cost position, so our transformation efforts are coming in exactly as planned. So the inflation, yes, it puts extra pressure, but we're quite confident we can meet our targets and continue to grow margin.
At the moment, you're not allowed to do significant consolidation because of the state aid that you took during the COVID downturn. You are looking to pay that money back, but there's a couple of names that spring to mind that are potential targets for you. Let's talk about ITA, the former Alitalia. Where are you with that? You're part of the consortium that could potentially take that business over. And can you specify where you sit currently with TAP, the Portuguese airline? Any interest there? Ben, can you just walk us through your plans?
So consolidation, of course, is key for us, especially in Europe. We do not want to be marginalized through this consolidation. We are still under restrictions imposed on us by the European Commission. We expect to be out of those in the short term. However, to date, it hasn't held us back from, as you mentioned, a bid for ITA. So we have a financial partner that is putting in the money. We have a commercial offer on the table, which is ourselves and Delta. We're still in the exclusivity period to finalize that negotiation, and we'll see how that goes. With TAP, Air Portugal, the Iberian Peninsula, we've been studying for many years. We've had a lot of debate and discussions around Air Europa. We did not come up with a deal on the Air Europa front. However, having a position on the Iberian Peninsula is key. So if the right circumstances are in place, we are very interested in looking at TAP in a closer way.
Benjamin Smith, the CEO of Air France-KLM. Thank you very much indeed, Francine.
That's it for Bloomberg Surveillance. What a great interview for a full spotlight on airlines and the markets. This is Bloomberg.
I think there is ample evidence that there is lower inflation in the pipeline.
Demand seems to be recovering too fast for supply to catch up.
Pretty tough outlook.
challenging in a lot of different respects.
I think actually revenue growth will probably be okay because inflation will probably be staying sticky and high. And companies will pass some of that through.
Everyone here is making it up as they go because we really have not been in this position for so many decades.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories this Friday. The tech wreck continues as Amazon predicts its slowest holiday season ever. Apple fares a little better, but it's still warning of a slowdown. Amazon shares down circa 12% pre-market. Musk takes over at Twitter. He's now expected to become CEO and will address staff later today. We're going to have the latest on that in a moment. And strong German GDP boosts hopes that a European recession can be avoided. But companies signal the winter is coming. Porsche fails to lift guidance. Volkswagen flags weakness. Valeo confirming low-end guidance. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Guy Johnson in London, Katie Greifeld and Kailey Leinz in New York. Anna Edwards, Matt Miller off today. BOJ, a big story as well. We haven't talked about that. Kailey, what's happening in Asia?
Well, in Asia broadly, you saw risk aversion prevalent when it came to equities. The MSCI Asia Pacific Index overall down more than 1.5% overnight. And really what was leading those losses is technology. Asia not immune to the downward drag of the disappointing earning results we saw from U.S. technology stocks and the big declines there. So that led the Hang Seng Tech Index down about 5.5% overnight. It actually had its worst week going back to May. But you mentioned the BOJ, Guy. It is so interesting to me that in the face of a very, very weak currency that has required intervention to stem its weakness twice, in the face of other central banks maintaining their trajectory toward tighter policy, Kuroda and the Bank of Japan are not caring at all. They continue to keep rates in negative territory. They continue their policy of yield curve control, and they did absolutely nothing to change the trajectory of their policy in their decision overnight. As a result, you have the 10-year JGB yield actually back below that 25 basis point cap that the BOJ would like to see in place at 0.248%. So that is the first time we've been under 25 basis points in about 3.5 weeks. But perhaps no surprise given that the BOJ is staying dovish and the Federal Reserve is absolutely not. You are seeing a weaker Japanese yen on the day by about 0.8%. We're trading at 147.41 at the moment, Katie.
Well, that risk-off sentiment definitely prevalent in U.S. hours pre-market. You're looking at the S&P 500 off by 0.8%. A lot of that pain is coming from the tech sector. Of course, after those Amazon results, the NASDAQ 100 off by about 1.2%. It's going to be hard for this index to go green with Amazon down about 13% pre-market. And you know it's bad when Bitcoin is outperforming the stock market. Bitcoin only off by about 1%, hovering around $20,000 a coin. We'll see if that changes. But what's interesting, none of this is sending a risk-off bid into bonds. You're looking at the 10-year Treasury yield actually higher by about 5 basis points, below 4%, but still higher on the day. Guy, that's what's happening over here. What's going on in Europe?
Well, we're certainly being impacted by the tech wreck and its ongoing narrative. We've also got our own corporates to factor in as well. Europe broadly, as you can see, a sea of red. The FTSE 100 down as NatWest gets hit hard. The banking sector's been under pressure all week. German industrials, French industrials also under pressure today. Volkswagen, Porsche, you got Valeo in France as well. So some negativity coming through. We'll deal with the details of the corporate picture in just a moment. Let me just give you an idea of what the macro picture looks like as well. We've actually had relatively strong German GDP data out today. The French numbers, the Spanish numbers, not quite so strong. And we've also had quite strong inflation data out for the month of October from France, 7.1%. That's the highest in 25 years. The Spanish number was actually a little bit below expectations. So the stock 600 down by 0.8%. Euro dollar still below 1. We're still digesting as well. Christine Lagarde's press conference yesterday at the ECB. Was it really as dovish as maybe the market has made out it to be? French yields, as you can see, getting a lift as we've just been hearing from Katie. You're seeing that certainly in the States as well. French inflation really quite strong today. And that is going to be factored into this kind of recession debate that we're seeing here as well. The other story I just want to mention as well is we've got a big day for corporate reports in big oil. Yesterday we saw Shell. We're going to get Chevron out of the States a little bit later on. Brent crude, 95.95. We're down by around 1%. But the tech wreck absolutely front and center over here as well, Kailey.
Yeah, and speaking of that tech wreck, I'm checking out Amazon and pre-market trading down a whopping 14% after it shocked Wall Street by predicting the slowest holiday quarter growth in the company's history. The CFO spoke in the earnings call yesterday. Take a listen.
We're very optimistic about the holiday, but we're realistic that there's various factors weighing on people's wallets. And, we're not quite sure how strong holiday spending will be versus last year.
Bloomberg's Danny Berger is joining us now for more. Danny, it's not every day you see a trillion-dollar company moving this way. Does the punishment fit the crime?
I mean, look, it is supposed to be their peak quarter. Holiday sales are so crucial for Amazon. So it's perhaps not surprising to see such a painful reaction in the share price, as you pointed out, down nearly 14%. And look, part of the problem isn't just a slower quarter. So 2 to 8% growth, that's what they see. That would be their slowest growth of any holiday quarter. But the context is also really important here. The fact that we just came from this period of Amazon spending a whole lot on warehouses, things like that, because it was so strong coming out of the COVID lockdowns or even around the COVID lockdowns. So there's this fear that they just did too much, too far, too fast, and now they have to deal with slowing sales. It also certainly doesn't help that their cloud services didn't come to the rescue either. So overall, you do get this bearish picture. How bearish is it for the consumer in general? I asked that to Paul Donovan, the economist over at UBS, and he says, look, I think that this is just the shift of a consumer moving away from goods to services. But of course, it means pain for Amazon.
And pain for Apple. It's interesting. The market is treating Apple as sort of a bright spot in the earnings that we got yesterday. But Apple also warned about the holiday season, didn't they?
Yeah, they did warn about it, Katie. I mean, to your point, it's up about 0.8%. But to just put it, Apple also in context of the greater smartphone market, it's really the only one that is able to see growth at all. Samsung, all the others, they've done even more poorly. So I think there's this hope that Apple, because it's on the top end of the market, it does have a consumer who perhaps less than usual, but still is willing to pay up more, to pay some of those top prices. So it did surprise on things like profit for the quarter. The question, of course, going forward will be, as inflation bites, as the consumer's wallet gets squeezed, will they continue to pay top dollar for the latest iPhone model?
Very nice, Danny. Thank you very much indeed. Bloomberg's Danny Berger on what's happening with technologies. There's another aspect of the story that we need to talk about as well. Elon Musk planning to assume the role of CEO at Twitter after completing his $44 billion acquisition of the business. Musk intends to replace Agrawal, who was fired, along with a number of other executives at the business on completion of that takeover. Alex Webb of Bloomberg Quick Take joins us now for more. So he's taken over, he's carried in the kitchen sink, executives have been fired, now what?
It is the big question. There have been a couple of things that have been mooted by him as well as some by others over the past few months. Firstly, Twitter's advertising business, it makes far less revenue per user. Firstly, it has far fewer users, but it has far less revenue per user than does Facebook, for instance. Now, that partly speaks to the lack of data in relative terms that it has about its users, but therefore also the worst targeting that it has. That's one thing he can improve. Secondly, he's talked about maybe introducing a paid tier. If that comes about, it's likely to be for corporates. If you're trying to reach customers or would-be customers on Twitter, you might have to pay for the privilege. And the third thing, and most sort of ambitiously, is talking about creating a super app. Now, this would be a very long-term project, and there would be lots of things that need to happen in order to get there. But if anyone's going to do it, perhaps Elon is the guy. He certainly has the strength of character.
Well, Alex, I'm curious what we know at this point about how the app, the experience of the user, might actually change, what that means for content moderation. A lot of question marks, but what do we know so far?
Well, it had been reported last week by the Washington Post that he was planning to cut up to 75% of jobs. He has now told Twitter employees he does not plan to cut that many jobs. The positions that look to be most vulnerable were things like content moderation. Twitter has worked very hard over the past few years to reduce spammy content, but there is still lots of, crypto hustling and other, adjacent things happening on the platform. that is something that is sort of deleterious to the user experience, but it's something that other platforms are vulnerable to as well. You see plenty of it on Instagram. Like Twitter has about 7,000 employees. A lot of people in the Bay Area seem to think that there's a lot of chaff there, unfortunately, for the employees. It's about focusing and making sure that the employees you have are doing something that is generating, recurring revenue.
Alex, thank you very much indeed. Alex Weber, Bloomberg Quick Take. As I mentioned just a moment ago, European earnings also coming thick and fast. Porsche seeing surging income, but that's failing to impress investors. Basically, it hasn't lifted guidance. Concerns over headwinds in the final months of the year certainly weighing on shares there. Meanwhile, let's call it still parent Volkswagen, cutting vehicle sales expectations for the year. Chip availability remains a big issue and chips remain scarce. Logistics continue to pose challenges. The company's CEO speaking to Francine Lacqua earlier today.
We are living in challenging times with numerous global crises, and the supply chain issue is one of this. What we have shown during the last months with our financial robustness, that we will be prepared for the future.
Let's talk about some of the stocks and talk about some of the movers that we're seeing. Volkswagen down by 2.2%. It's really the outlook going forward from here that is hitting these companies. Porsche is exactly the same as well. Porsche's numbers are really strong. Their top-end products are selling, flying off the shelves at the moment. There are waiting lists. Demand is very, very strong, but they didn't lift guidance. And that is why the stock is tracking a little bit lower this morning. P911 down by over 3% today, trading at 96.24. Currently looking good. The outlook may be a little bit more murky as well. And then I want to wrap things up with the banking sector, because this is where we are certainly seeing weakness across Europe and have done over the last week. NatWest Group, formerly the Bank of Scotland, trading down by 8.24% this morning. That is a huge reaction to what looks like a moderately cautious outlook on costs and provisioning. A very big reaction coming through there. The market's certainly taking fright. That stock being hit hard, and by extension, the FTSE 100, Kailey, under some pressure.
All right, guys, so that's what's going on with the earnings story in Europe. We have a lot of earnings-related movers here in the U.S. as well, so let's check out how some of those are doing in pre-market trading. The other big tech-related company that reported overnight, other than Amazon and Apple, was Intel, the big chip maker. Perhaps no surprising, given what we've been hearing from chip makers lately about the weak macro and demand environment. It wasn't pretty. Its revenue was tumbling. Its forecast also not great. What the positivity investors seem to be clinging to is the plan to cut costs by as much as $10 billion. So as a result, despite those less than stellar results, Intel is up about 4.7% before the bell. It is also a big move to the upside for Pinterest. It actually beat on the top and bottom line, and users topped expectations. So it seems to be faring well relative to other social media peers that are really struggling in a weaker ad environment. So Pinterest is up about 8%. One stock sinking, though, after earnings is First Solar, obviously a solar company. It is expecting a wider loss than expected previously, and larger than what analysts were anticipating, and as a result, that stock down about 7.25% before the bell, Guy.
We're getting more data out of Europe that is confusing the picture further. I mentioned a moment ago that we had strong French data today on the inflation front. The Spanish number weak, but the Italian number super strong. This is October data. This is EU harmonized CPI data, 12.8%. Let me just give you an idea of what the estimate was. The estimate was 9.9%. So we have smashed this story on the upsides. And it's going to really, I think, confuse the picture at the ECB, which sounded, to many people's ears, quite dovish yesterday. We'll talk more about that dovish ECB story. Tatjana Greil Castro, co-head of public markets at Muzinich, is going to be joining us next. We've also got the tech story coming up as well in more detail. Neil Campling, Mirabaud, head of TMT Research, is also going to be joining us later in the show. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Katie Greifeld with Kailey Leinz in New York and Guy Johnson in London. Anna Edwards and Matt Miller are off today. And it's all about the tech wreck this morning, but we do have a big Federal Reserve meeting next week. And if you look at what's happening in the equity markets over in the States, trying once again to trade the Fed pivot, the idea that the Fed is going to maybe dial back some of the aggression in its rate hikes. You're looking at expectations for the Fed's terminal rate, that's that blue line inverted, seems like we're stalling around 5% for the Fed's end destination. If you look at what's happening with the S&P 500 in white, you can see we have tried and failed over and over again to trade the idea of this pivot. Looks like markets are making a run at it once again. Let's talk about that with Simon White. He is Bloomberg macro strategist. He joins us now. Simon, is there any reason to think that this time might be different when it comes to the pivot trade?
Well, I think so. I think you need to differentiate between the Fed pivot and peak Fed hawkishness. And I think we are at the point of peak Fed hawkishness. We had the now infamous Wall Street Journal article last week. We had some comments from Daily. And I think this is where we are right now, where we're getting to that sort of peak in hawkishness. But that is different from the pivot, because I think what would then happen is that we maintain a higher rate. The rate doesn't actually go much higher, but it gets to its high. And then that pivot that everybody talks about actually comes out, and we end up with a higher for longer situation in the curve.
Central banks are betting that inflation is coming down, it seems. Like, I listened to Christine Lagarde yesterday. They're punting that this is going to maybe be transitory. Transitory is a dirty word, I know. But I look at the Italian data this morning, I look at the French data this morning. They're already being confounded, aren't they?
It's brutal. If you start to look at where European curve is, they're way behind the curve, right? What happened in the UK, they had a shock, right? We had obviously a fiscal shock. All of a sudden, the Bank of England is down here, but where the market's expecting is way up there. The European curve is super flat. So the fact that even the market took them as dovish, and they are, I think, trying to be dovish, is something that's quite astonishing to me, because, as you say, inflation is something that is probably much stickier than anyone's expecting.
If it's much stickier than anybody's expecting, what does that mean for equities? Are we done yet? It doesn't certainly seem so.
It's a huge problem for equities, because the best medium-term driver is excess liquidity, and that's very low, and that's not going to change while central banks are having to keep hiking. So equities are going to have this continual headwind, and I think this buy the dip mentality, which is still there right now, is going to suffer a lot of disappointment.
Well, especially, Simon, if big tech can't hang in there. I mean, the fact of the matter is the majority of a huge chunk of the U.S. market is technology. If that leadership is not provided, can anything realistically lead? Because, okay, sure, energy's doing fine, but that's what, 5% of the S&P?
Precisely. I mean, look, obviously the earnings announcements we saw, I think, keep repeating to yourself, earnings are not a leading indicator. If you look historically, earnings don't start falling until after a recession. Forward earnings are even worse, like this hope over kind of reality kind of persists even longer. The economy in the US is clearly slowing. I think a recession is all but inevitable in the next 3 to 6 months. And things are now just beginning to catch up. So as I say, this kind of buy the dip mentality in stocks is something that's going to suffer. And also, this negative correlation in stocks and bonds, that's going to reassert itself, but not in the way that people want. Stocks are going to go down and bonds are going to go up.
And finally, Simon, on the subject of bonds, you are seeing the 10-year yield basically back at that 4% level once again, yields moving up, really a move led by Europe after that hot inflation data that Guy was talking about. What is priced in the bond market now? Because the moves have been confounding.
Yeah, I mean, look, as I say, the way I'm looking at it, you have, I think we're at peak Fed hawkishness. I also think we're at peak global hawkishness. So I think that is going to take a lot of the edge off the rise in yields for the time being. But this is really an interim kind of trade, because the bigger thing, that, as we discussed earlier, is inflation is sticky. It's not going away. And, the markets will try and price in a recession. It'll be a haven bid. But the much bigger picture, like I'm talking 1 to 2 years here, is potentially much, much higher yields, because inflation is something that's going to be around for much longer than I think most people expect.
That's certainly not in the price. Simon, very nice as ever. Thank you very much indeed. Bloomberg's Simon White. And for more market analysis, of course, all you've got to do is go to your Bloomberg terminal, punch in MLIV Go, and you get all of this fantastic analysis. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Katie Greifeld in New York and Guy Johnson in London. Anna Edwards and Matt Miller are off today. Now, keeping you up to date with news from around the world, here's the first word. In China, Premier Li Keqiang has repeated pledges to stabilize the economy and stimulate growth in the fourth quarter. Lee says it's crucial to implement measures addressing the lack of effective demand and to boost consumption. This week, data showed China's economic growth accelerated to 3.9% in the fourth quarter. Meanwhile, in Japan, the BOJ is standing by its ultra-low interest rates. The central bank left its negative rate, 10-year yield cap, and asset purchases unchanged today. The BOJ continues to predict inflation will fall below 2% next year. Meanwhile, Prime Minister Fumio Kishida announced around $200 billion in new spending to boost growth and ease the impact of rising prices. President Biden is questioning whether Vladimir Putin is sincere in saying he won't use chemical or nuclear weapons in Ukraine. The president said, quote, "If he has no intention, why does he keep talking about it?" On Thursday, Putin said there was no need for Russia to launch a nuclear attack on Ukraine. And hopes that the Eurozone can stave off a recession got a boost today. Germany defied expectations by reporting another quarter of economic growth. The country's GDP rose by 0.3% in the third quarter, but momentum slowed in both France and Spain. French growth went from 0.5% to 0.2%, and in Spain, GDP rose a worse than expected 0.2%. Plus, you also had that hot inflation data out of Italy to contend with, all of that against the backdrop of an ECB decision yesterday that was perceived as dovish. How right is that assessment? We'll continue the conversation coming up next with Tatjana Greil Castro, co-head of public markets at Muzinich. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know this Friday. The tech wreck continues as Amazon predicts its slowest holiday season ever. Apple faring a little bit better, but it's still warning about a slowdown. Amazon is trading down circa 12, 13, 14% this morning. Musk takes over at Twitter. He's now expected to become CEO and will address staff later today. And strong German GDP, boosting hopes that a European recession can be avoided. Companies, though, signaling that winter is coming. Porsche failing to lift guidance, Volkswagen flagging weakness, Valeo confirming low-end guidance. And then you've got the inflation data that we've seen out of France and Italy today. Both numbers strong. I'm Guy Johnson in London, Katie Greifeld and Kailey Leinz in New York. Anna and Matt are both off today. We got a lot to think about. Katie, let's talk about what the setup looks like.
If you look at the U.S., it's still risk off, but not as much as maybe it was about 30 minutes ago. You have the S&P 500 in terms of futures down about 0.8%, but Amazon just like a rock on the NASDAQ 100 in terms of pre-market action. That index down about 1.2%. Like I said earlier, Bitcoin outperforming the big tech benchmark, only off about 0.8%, hovering around $20,000 a coin. Still really interesting to see if that setup holds. And the 10-year Treasury yield continuing to rise up 8 basis points, getting closer and closer to 4%. We are just a hair away, Kailey.
I think if it's 3.9999%,
I can round that up.
We can probably just call it 4%, Katie. Now, as you talked about, Amazon, a huge drag today. Remember, this is a company worth more than $1 trillion, or at least it was as of yesterday's close. With this move lower today, we'll see if that can hold by the end of the trading session, because it's down about 13.5% in pre-market at the moment. Slowest holiday sales growth ever is what they're forecasting. And the issue also is that even as the retail business is facing headwinds, other segments of its business, like AWS, don't seem like they're going to ride to the rescue because they were a little bit soft as well. Now, there was some softness for Apple, too. It, too, is expecting a slowdown in the holiday quarter. iPhone and services coming up, revenue coming up a little bit short, but the market is treating it more kindly today, up about 0.6%, because elsewhere the results were fairly positive. Intel also getting a boost. It isn't about the quarter they reported because revenue was tumbling due to the slowdown in the chip space, but they are planning to cut up to $10 billion in costs. As a result, the stock up 4.6%. And then Pinterest, an outperformer this morning. Social media broadly not faring very well in a softening ad environment. Pinterest, though, managing to top expectations on users, profit, revenue, all of it. So it is up about 7.5% before the bell guide.
Corporate news over here. Pretty grim as well, I have to say. You've got better numbers out from Air France-KLM, but you take a look at what is happening elsewhere. Porsche, the guidance issue, Volkswagen, number of challenges. Valeo also weighing on the French market today. So the stock 600 down by around 0.7%. What's happening with Amazon also having a fairly big impact as well. I'm surprised we're not getting a bigger reaction in euro dollar today. So the ECB was perceived as being dovish yesterday, but you take a look at the inflation data out of Italy and France this morning, neither look particularly good. And actually the GDP data out of Germany looks okay. That may make the ECB maybe a little bit more hawkish. So the French 10-year, we're up by around 16 basis points today, as you can see, 2.628 on the OAT. And we've got a number of big oil companies reporting a little bit later on, Katie. Brent crude, 96.13. We're down by 0.9%.
Let's get into all this with Tatjana Greil Castro. She is co-head of public markets at Muzinich. And like Guy said, the ECB yesterday perceived as dovish. Then you have just a raft of macro data today in the euro area, from GDP to inflation. Is the ECB going to be able to maintain that maybe dovish stance, or are they going to have to pivot more hawkish?
Yes, that's a very good question, because I think the data shows that they may be a little bit too early in that shift. So both in terms of GDP and the likelihood of recession, how large the recession is, but also more so if inflation is coming down. So in our view, that has been a bit too early to sound so dovish. Maybe they didn't want to sound that dovish. I mean, you see that the ECB generally is not as bad as the Bank of England with changing their minds, but it's also not as steady fast as the Fed. It lies somewhere in between. And it seems that the doves yesterday sort of won over a little bit, and therefore communication was as it was. But what you can see already, that sort of the rally yesterday seems a bear market rally, and we are coming back to data. So I'm unsure if they can keep the dovish tone.
And Tatjana, let's push this conversation into the Fed next week, because the Fed has this reputation of really being the world's central bank. But when you think about the data that we got out of Europe today, do you think that the Fed is paying attention to what's going on in the rest of the world at this point, or do you think they're chiefly focused on what's happening in the US?
I think they are focusing on what's going on in the rest of the world, to the extent that it is messing up their picture with regards to rates. As you saw yesterday, there was a very strong response to rates also in the US. Again, this is now sort of being rolled back. But if that was to persist, I would think that the tone just stays very steady fast, so that nobody is under any illusion that they would pivot, similar to what the ECB has communicated yesterday, that they're very much sort of worried about the recession and what that means to unemployment, and that may be sort of almost forgetting inflation, really.
Yeah.
So I think the Fed is far more single-minded.
Tatjana, is there a danger here that we are underpricing inflation? Like, I look at the Italian number this morning, I look at the French number this morning. Those numbers are much stronger than anticipated by economists. I look at the latest batch of data out of the US, stronger than anticipated. Why do you think that we are in a position where we now believe that inflation is going to come down? Is there a danger that it is much stickier than we anticipate?
I completely agree with you, Guy. Completely agree. So if you were to take a longer history on where interest rates were and also where inflation was, then over the last 15 years or so, inflation ran around over 2.5% in Europe, over 3%, 3.5% in the US. So we used to have much higher inflation. So this idea of because we had such high numbers, it can't stay above 2% for very long for statistical sort of methodological reasons is completely unfounded. And when you see what the momentum is and continue to be in terms of the growth momentum, and let's not forget, gas has come down significantly. We have very warm weather here. There's an expectation for a warmer winter. So that drag is not dragging down the economy. So all this is indicating that inflation is remaining higher for longer. And remember, interest rates used to be 4 or 5%. before the financial crisis, and there was not anything unusual. Yes, we have much higher debt levels now, so they may not go just as high, but they can come to similar levels.
Well, Tatjana, as we talk about interest rates going up in places like Europe and the U.S., there is somewhere where they are not, and that would be Japan. The Bank of Japan overnight keeping policy as it is, which means ultra low rates, continuing to buy bonds, continuing to maintain yield curve control. And as we've been talking, the Japanese yen extending losses against the U.S. dollar now by about 1%. We're back up at 147.76, which might put us back on intervention watch yet again after we've already twice seen it in just the last several weeks. When does the BOJ have to crack, Tatjana?
I guess, when it has to crack is really, as in when inflation in Japan is also picking up, and it's surprising that it continues to be so low. Is it the right policy to be as accommodating? For the time being, if they really want to have sort of a similar lift, it may be, but at the same time, it's very inconsistent with, supporting the yen, but at the same time, keeping rates so low. So I guess they were burned so many times in the past that they thought inflation is now on a higher trajectory, and then never materialized. So I can see why they're so cautious around not being as supportive, but it may still be some time before inflation is sort of strong enough that they feel confident in stopping this accommodative policy.
I'll tell you what, European yields are ripping higher right now, really across the board. Tatjana, thank you very much indeed. Tatjana Greil Castro, Muzinich, thank you very much indeed. Coming up, we're going to be back to the tech wreck. Neil Campling, head of TMT Research at Mirabaud, is going to be joining us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Mike Wirth, the CEO of Chevron. That's at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
Overall, we believe total company year-over-year revenue performance will decelerate during the December quarter as compared to the September quarter for a number of reasons. First, we expect nearly 10 percentage points of negative year-over-year impact from foreign exchange.
That was Apple's CFO speaking during the company's earnings call yesterday. Apple warning of a holiday season slowdown, but it is dodging the tech route after revenue and profit beat expectations. Amazon, however, is not. It shocked Wall Street by predicting the slowest holiday quarter growth in the company's history, and the stock taking a beating in pre-market trading as a result, down about 13.5%. Joining us now to discuss how appropriate that move is Neil Campling, head of TMT Research at Mirabaud. Neil, it's not just Amazon with a big decline after earnings. We saw Meta brutally punished yesterday, down 25%. Microsoft down about 8% after its results. Alphabet by 9%. These are really big moves for really big companies. I asked this question earlier, but do these punishments fit their crimes?
Great question. I'm afraid they do, because we are late in the technology cycle now. Late in the economic cycle. We are seeing multiple pressures, which obviously are well telegraphed in terms of the consumer, but they are now spreading through to corporate spending. And there's a change in message. The change in message now from investors to companies is to focus on profitability, is to focus on delivering operating leverage, which is what tech companies should be able to do. And we have moved past the, should we say, the central bank fueled printing presses time where growth at any price was rewarded, and now it has to be growth at reasonable price that will get rewarded by the markets.
Okay, so I guess the next question realistically is how bad could this get and how far could it go? I was noting one analyst over at Vital Knowledge this morning saying we think tech is entering a period similar to the dot-com boom and bust. Is that really what this is akin to?
There are similarities. In fact, if you take the 5 sort of mega cap tech companies today, they have all missed in terms of either numbers or expectations. That includes Apple as well. Don't forget that Apple themselves haven't given explicit guidance, but actually there were many weak parts within their numbers, including their services business. It feels similar to the four horsemen of tech from Q1 2000 in many respects, which is where you need to have investors reset expectations. What we haven't actually yet had is total capitulation in terms of investors. We've not had a massive change of the shareholder structure, and we've not yet seen the likes of companies like Apple and Tesla retest the pre-COVID lows, which feels like it needs to happen, and for investors to abandon some of these perceived growth stocks that have won in the last few years. But certainly, obviously, in terms of free cash flow generation, in terms of the absolute numbers of revenues, we are very different from 2000. But where the similarity is now in 2022, like the GFC and like Y2K, is that there are similarities in terms of we need that reset. We need to have kind of capitulation of investors. We need to have multiple compressions still. Apple still trades on 22 times earnings. If you're looking at through cycle for the last decade, the stock actually did trade as low as 9 times earnings. It still needs to come as a multiple compression, in my view.
Neil, good morning. It's Guy. To what extent is US tech a dollar trade now as well?
Absolutely. I mean, the impacts of the dollar are absolutely massive. And you can see that Amazon talked about a 450 basis point hit just from the effects of the strong dollar. If you look at the growth in terms of Microsoft, in terms of what they produced the other day with Azure, there was a 500 basis point hit to the growth rate because of the strong dollar. So without doubt, the dollar impacts are significant. Perhaps, again, Apple managed to avoid some of those issues because it's been very aggressive on pricing internationally. The prices of many of the products are more expensive, clearly, in international markets. 18% increases of the iPhone price in sterling, for example, and in the euro, which is okay for helping Apple's returns in the short term. But actually, longer term, it could have a negative impact in terms of consumer demand for actually going out to buy the products.
Neil, I want to switch gears and talk about Meta. I'm obsessed with the metaverse. Mark Zuckerberg is too, making that hard pivot into the metaverse. It's interesting. You have Amazon, you have Intel cutting costs. Meta is not, still funneling a ton of money into that effort. How does this end?
Well, it either ends in 5 years' time with us looking back and going, wow, he is a genius, or we look back and go, oh dear, unfortunately, Zuckerberg didn't get the memo about cutting costs, which actually he hasn't so far. And actually, there is no proof to date that any of the pivots into new ideas that Facebook or Meta or whatever the name will be next week actually works. Because take some examples. Oculus, for example, 50% of Oculus users don't use the device after 3 months of purchase. That's a shocking statistic, I think. For every dollar of OPEX that Apple spends, it translates into $6 of sales. For every dollar that Meta spend on their operating costs, it translates into $1.18 in sales. That is something that is going to be held to task, I think, by investors. And there is no proof yet. So far, let's take a step back here. So far, $15 billion has been spent on the metaverse by Meta to create floating avatar bodies. A further $10 billion, and we now have legs to attach to those bodies. There's no economic model yet to prove that the metaverse will be successful for them. And probably the biggest application for the metaverse is perceived to be gaming. Facebook, Meta have no presence in gaming whatsoever, and every attempt they've made into that has been a failure.
Well, Neil, before we let you go, it's really interesting to me that the shareholders really have not given Mark Zuckerberg any sort of patience here. The stock is down 69% over the past year, well lagging the NASDAQ 100, for example. At what point does the board step in, or does Mark Zuckerberg have total control here?
Well, there isn't a change in terms of the structure. In terms of since the IPO, we've known that Zuckerberg has basically a super voting class stock. This is not uncommon for tech companies. Ever since the Steve Jobs time when he was booted out of his own company and had to come back and reinvent. The problem here is that Zuckerberg has that super class of stock, which means that he really has to answer to no one. And I'd argue that in many respects, his vision was kept in check and also in relation to shareholders' expectations by Sheryl Sandberg. Now that she's no longer there, he is really left with no one to answer to. And that becomes a big problem, I think, for shareholders looking to get good returns from the stock.
Great stuff, Neil. Thank you very much indeed. Neil Campling of Mirabaud. Greatly appreciated. Coming up, the countdown to Brazil's presidential runoff is now on. Lula leads in the opinion polls over his opponent, Bolsonaro. 2 days to go. Brazilians are going to be casting their vote shortly. We'll be live in Brazil to give you the latest ahead of the weekend. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Katie Greifeld in New York and Guy Johnson in London. Anna and Matt are off today. Now let's take a look at what they're missing, what's coming up in the day ahead. Russia's key policy rate decision is at 6:30 a.m. New York time. In earnings, both Exxon and Chevron are due to report. And we'll get some U.S. economic data, including personal income and University of Michigan sentiment. Guy will be breaking that in the 10 a.m. Eastern hour. And then finally, this weekend, Brazil's presidential election will be taking place on Sunday. Definitely a big one to watch, Guy.
Absolutely, and it's a tight race, of course, between Brazil's Luiz Inácio Lula da Silva and the incumbent President Jair Bolsonaro. It's one of the most watched political events in emerging markets right now. Brazilian assets, though, have been a real hot trade recently. They jumped yesterday after Lula da Silva promised fiscal and social responsibility. Bloomberg Sherry Ann joins us now from Sao Paulo. Sherry Ann, Brazil has been the hot trade recently. How's that trade holding up as we watch this political uncertainty developing?
It's been quite interesting because the political uncertainty has been high, especially given that after the first round of voting earlier this month, it was such a contested election, very close. Bolsonaro really outperforming more than markets had expected. But still, you mentioned that Brazilian assets jumped, the real jumping as much as 2.6% after we got that letter from former President Lula really reaffirming that social and fiscal responsibilities. A hot trade, as you said it. Brazilian stocks have outperformed global peers this year. We have seen, of course, valuations still historically pretty attractive when it comes to the carry trade, double-digit returns. So investors are very optimistic about this country, about the assets, given that whether or not is Lula or Bolsonaro, they're both expected to keep the fiscal outlook for this country.
And quickly, Sherry, what about the polls? You're obviously in Sao Paulo right now, which is a very important area in terms of voting population. What is it looking like?
25% of all voters of Brazil are here in Sao Paulo, and Bolsonaro surprisingly won this state. Bolsonaro's appeal has been fading a little bit, especially this week. We had a series of incidents and gaffes, including one of his allies getting into a violent gunfight with police. So that has really dampened his appeal a little bit this week, just 2 days to go until the Sunday elections. But Datafolha just coming out and saying that Lula's popularity has increased to about 53% of valid votes. That's what's expected, up from last week. Bolsonaro expected at around 48%.
All right, Bloomberg Sherry Ann reporting from Sao Paulo. Thank you so much. Looking forward to your coverage of the election this weekend, and we'll get more from you on Monday morning. That wraps it up for Early Edition on this Friday. Thank you, Guy and Katie, for being here. More surveillance is ahead with Tom, John, and Lisa. This is Bloomberg.